While most people were celebrating the new year, something quietly but decisively broke inside the global silver market. Not strained, not delayed, broken. As I record this on January 1st, 2026, physical silver is already trading in a completely different reality than the price still frozen on financial screens. Dealer prices are jumping 30 to 50% above paper prices in a single day, not because of speculation or hype, but because real supply just vanished. This didn't begin with headlines or analyst notes. It began with emails, not warnings, cancellations. Long-standing contracts erased overnight, orders confirmed weeks earlier suddenly denied. And the explanation was identical every time: Chinese government export restrictions effective, immediately, no exceptions. While most investors were distracted by holiday supply chains that took decades to build were shut down in a single policy move. This is not a logistics problem. It isn't labor unrest or a temporary bottleneck that clears itself in a few weeks. This is a deliberate, calculated action by the country that controls the most important choke point in the silver market: refining. For more than 20 years, miners around the world shipped silver concentrate to China because that's where the capacity, efficiency, and economics made sense. At midnight Beijing time, that access fundamentally changed. When a market quietly centralizes for decades and then suddenly reverses, price doesn't adjust smoothly, it snaps. The paper price reflects yesterday's assumptions. The physical price reflects tomorrow's reality. And the widening gap between them is the signal most people won't recognize until after the market has already moved. If this kind of analysis helps you see what others are missing, subscribe and type 1 in the comments so I know you're following closely. To understand why this moment matters, you have to separate mining from refining, because the market constantly confuses the two. Silver is mined all over the world. Australia produces it, Mexico produces it. Peru, Chile, the United States all produce silver-bearing ore. That part of the supply chain looks diversified on paper, which is why most analysts stayed calm when the policy was announced months ago. But mining silver and having usable refined silver are two very different things. Ore is not what factories use. Solar panels don't run on ore. Electronics don't function on concentrate. What industry needs is refined silver in specific purities, forms, and delivery schedules. And for more than 20 years, the world quietly optimized that middle step by sending it to one place. China didn't just build refineries. It built scale, efficiency, financing structures, and logistics that made it economically irrational for miners to refine anywhere else. Western producers didn't lose capacity by accident. They outsourced it because it was cheaper, faster, and more profitable. That decision worked perfectly until it didn't. Because when refining becomes centralized, it also becomes a point of leverage. China doesn't need to own the mines to control the flow. It only needs to control the conversion from rock into metal. And that's exactly what most investors missed. This export restriction isn't about China hoarding silver for itself. It's about China deciding who gets access to the silver it refines after the work is done. That distinction changes everything. It turns a commodity market into a permissions-based system. It means supply isn't governed by price alone anymore. It's governed by policy. And once policy replaces price as the controlling mechanism, the market stops behaving the way textbooks say it should. This is why the reaction you're seeing now feels sudden. The vulnerability was built over decades. The trigger took one night. What makes this situation especially dangerous is that the policy itself was not a surprise. The Chinese Ministry of Commerce didn't act in secrecy. Back in October, new export licensing requirements for refined silver were publicly announced, scheduled to take effect on January 1st. The rules were written in plain language, and yet most of the market ignored them. Why? Because markets don't react to information, they react to enforcement. And until enforcement becomes real, investors assume exceptions will appear. The requirements look technical on the surface, but their implications were profound. To qualify for an export license, a refiner must produce at least 80 metric tons of refined silver per year and maintain established credit lines of no less than $30 million. Even if a refiner met both thresholds, every single export shipment would still require separate government approval. No blanket permissions, no standing contracts. Every shipment reviewed individually by officials in Beijing. When these rules were announced, Western analysts debated them academically. Some flagged the risk. Many dismissed it as political signaling. There was a widespread belief that China would never fully enforce restrictions that might hurt its own refining industry. The assumption was that grace periods would be granted, exemptions would be carved out, or existing contracts would quietly continue. Markets are very good at convincing themselves that tomorrow will look like yesterday. January 1st shattered that assumption. When refiners were contacted directly, the answers were not vague or uncertain. They were precise, consistent, and confident. Refiners knew the exact thresholds. They knew whether they qualified. And most importantly, they knew that if they did not qualify, export was no longer legal. There was no confusion, no waiting for clarification, no expectation of leniency. This is the moment when policy stops being theory and becomes a physical constraint. It's when risk stops being hypothetical and starts canceling contracts. And once that line is crossed, markets don't calmly reassess. They rush. When people hear that most refiners said no, they often underestimate what that actually represents. This wasn't a survey. It wasn't rumor or hearsay. These were direct commercial conversations with refiners across multiple provinces, different ownership structures, and different production scales. And the results were remarkably consistent. Out of 30, refiners contacted 28 stated clearly that they could not export refined silver to Western buyers under the new rules. Not temporarily, not conditionally, at all. The reasons matter. Many of these were not small operations. Several had been exporting silver for over a decade, but once the numbers were applied, they simply didn't qualify. Some produced 60 or 70 metric tons annually. Close, but not enough. Others met the production threshold but failed the financial requirement because their business models relied on consignment arrangements rather than large, standalone credit facilities. The policy didn't care. The thresholds were binary. You either met them or you didn't. What stood out was how prepared the answers were. Refiners referenced exact figures without hesitation. 80 metric tons, $30 million, January 1st. There was no confusion about timing or interpretation. They had already applied. They had already been rejected, and they already knew the outcome. Domestic sales were permitted. Exports were not. Even more revealing was the tone. There was no anger, no negotiation, just acceptance. These companies understood that the rules were not designed for flexibility. They were designed for control. And that realization changes how you think about risk. When suppliers know the rules are final, they stop trying to work around them. They stop promising deliveries. And the moment suppliers stop making promises, buyers are forced into the open market all at once. That is how shortages stop being abstract and start becoming immediate. The story doesn't become less severe when you look at the refiners that technically qualified. In fact, it becomes more unsettling. 8 of the 30 refiners contacted did obtain export licenses under the new framework. These were the largest players, the ones with sufficient scale and financing to clear both thresholds. But a license, as it turns out, does not mean permission. It means eligibility to ask. Under the new system, every single shipment requires separate government approval. Buyer destination quantity, intended use, and delivery timeline must all be submitted for review. There is no automatic flow of metal. According to multiple refiners, that approval process takes a minimum of 4 to 6 weeks and sometimes longer. And approval is never guaranteed. Officials can deny a shipment for any reason, including prioritization of domestic demand. One large refiner explained it plainly. They have the license, but they cannot plan exports. Requests are reviewed one by one, and recent decisions have favored Chinese industrial buyers. Another refiner was even more direct. They estimated the probability of approval for new Western buyers at less than 20%. That is not a supply chain. That is a bottleneck disguised as compliance. For an industrial company in the United States or Europe, this creates an impossible situation. Manufacturing timelines are measured in days and weeks, not months. A company cannot wait 6 weeks for a decision that has an 80% chance of denial. So even licensed refiners are no longer reliable suppliers. In practice, they are unavailable. The remaining refiners offered a third response. They said they were waiting for further clarification and were not accepting any new export orders. No commitments, no timelines, no guarantees. When you add those responses together, the effective denial rate is not 93%, it is 100%. At that moment, supply didn't tighten. It disappeared. Once supply disappears at the source, the impact doesn't stay theoretical for long. It shows up in contracts. And that's exactly what began happening almost immediately. Western companies that had relied on Chinese refiners for years started receiving formal notices within hours of the policy taking effect. These were not informal conversations or tentative updates. They were written cancellations citing the January 1st export restrictions as the reason. An electronics manufacturer with a long-standing quarterly agreement submitted its first quarter order just days before the new year. The order was confirmed. On January 1st, it was canceled. The refiner explained that their annual production capacity fell below the required threshold and that export was no longer permitted. The recommendation was blunt: seek alternative suppliers outside China. When that company contacted other Chinese refiners as backups, the responses were nearly identical. Export was not possible. Delivery timelines from domestic U.S. sources were quoted at 18 to 24 weeks. A solar panel producer faced an even harsher reality. They had a decade-long relationship with a specialized refiner supplying high-purity silver critical to their manufacturing process. The refiner's license application was denied. The contract was terminated effective immediately. That company has roughly 6 months of inventory. After that, production lines slow or stop unless replacement supply is found. Alternatives in Australia and Canada were already fully contracted through 2027. An automotive component supplier had a licensed refiner, but their February delivery request was denied without explanation. Domestic Chinese demand was prioritized. No appeal process was offered. The message was clear: foreign buyers were no longer first in line. These are not projections or scenarios. These are supply chains breaking in real time. And when multiple industries all lose the same supplier, at once they don't adjust gradually. They rush to the same limited alternatives. That's how a policy decision becomes a market shock. To grasp the scale of this shock, you have to look at the numbers that just vanished. China refines roughly 600 to 700 million ounces of silver every year. Not all of that is exported. A significant portion stays inside China for domestic manufacturing. But estimates suggest that 350 to 400 million ounces per year had been flowing into Western markets as refined silver. Industrial users, mints, bullion dealers, and large institutions all depended on that stream. As of January 1st, that flow effectively stopped. The immediate question is whether that supply can be replaced. On paper, some analysts will say yes. In reality, the math is brutal. Global primary silver mine production is around 250 million ounces per year. But roughly 70% of silver is produced as a byproduct of other metals like copper, lead, and zinc. That byproduct silver is already contractually tied to existing smelters and refiners. It cannot be quickly redirected. The amount of uncontracted primary silver production that could theoretically be rerouted is perhaps 120 to 150 million ounces annually. Beyond that, buyers look to inventories. The COMEX registered vault holds roughly 40 million ounces available for delivery. London vaults hold far more, but most of that silver is allocated to ETFs or long-term custodial accounts and is not available to industrial buyers. Commercially accessible inventory is estimated at 50 to 100 million ounces at best. Retail dealer inventory in the United States is perhaps 20 to 30 million ounces, already drawn down by months of heavy buying. Add it all together and the picture is clear. Western markets just lost access to roughly 400 million ounces per year. The maximum replacement supply that could be mobilized under ideal conditions is closer to 300 million. And much of that is already spoken for. What remains is a structural deficit that cannot be wished away with optimism or paper contracts. The shortfall won't appear slowly over time. It hits immediately as every buyer scrambles for the same limited pool of silver outside China. This is why the most important signals right now are not coming from charts or futures exchanges. They're coming from the physical market. While paper markets were closed for the holiday, dealers were forced to confront a world where replacement supply suddenly costs far more if it can be sourced at all. and they reacted the only way a rational business can. They repriced immediately. On January 1st, multiple major U.S. precious metals dealers adjusted prices sharply higher, not in anticipation, in response. Replacement costs from wholesalers jumped by 30 to 40% as soon as Chinese supply was assumed unavailable. American Silver Eagle prices moved from the low 100s into the 115 to 120 range within hours. Some dealers went higher, others followed quickly behind. What's critical is the reasoning. Dealers weren't trying to exploit a moment, they were trying to survive it. Selling silver at yesterday's price when tomorrow's replacement cost is dramatically higher is a guaranteed loss. Several dealers made the same point independently. They would rather raise prices now and still have inventory than sell out instantly and have nothing to offer next week. This is how real price discovery happens. Not on a screen, but in the decisions of people who must replace inventory or shut their doors. Premiums of 50 to 60% above the last paper price are not premiums anymore. They represent a different price regime entirely. Two markets are now operating side by side. One reflects contracts written in the past. The other reflects metal priced for the present. When physical prices move this far, this fast, it's a message, and it's not subtle. The tension now lies in what happens when the paper market is forced to acknowledge what the physical market has already priced in. Futures exchanges are where price discovery is supposed to occur, but only when they are open, and only when participants are paying attention. While traders were away for the holiday, the physical market moved without them. That creates a dangerous gap because when liquidity is thin and information hits all at once, prices don't glide, they gap. When institutional desks reopen, the first thing they will see is not a chart. It will be phone calls, industrial clients asking why Chinese supply is gone, procurement teams demanding alternatives, dealers quoting prices that are wildly out of line with the last settled futures price. In that moment, theory collapses. The paper price becomes indefensible. If you cannot source metal at the posted price, that price is fiction. In markets like silver, where liquidity is already thinner than most investors realize, sudden concentrated buying creates violent moves. Large orders placed at the open don't get absorbed smoothly. They jump levels. That's how gaps form, and once a gap forms, it attracts momentum. Traders who miss the move chase it. Shorts rush to cover. Risk managers force adjustments. What begins as repricing becomes acceleration. This is why convergence matters. Either physical prices fall dramatically or paper prices rise aggressively. Given the supply math, the first outcome makes little sense. You cannot price silver cheaply when hundreds of millions of ounces are unavailable. Price must rise to ration what remains. That's not speculation. That's how commodity markets function when scarcity is real. The physical market has already voted, the paper market just hasn't cast its ballot yet. This is the point where everything comes together. What happened on January 1st was not a rumor, a headline, or a temporary disruption. It was the enforcement of a policy that systematically removed hundreds of millions of ounces of refined silver from Western supply chains. The denials are documented. The contract cancellations are real. The delivery delays are measurable, and the price response in the physical market is already visible. The lesson here is not about silver alone. It's about structure. Markets that appear diversified can still be fragile if a critical step is centralized. For decades, efficiency masked risk. Refining was outsourced costs, fell margins improved, and few questioned the dependency that was quietly being built. When that dependency was tested, it failed instantly, and price is now doing what policy set in motion. For investors, the takeaway is clarity, not panic. Markets move fastest when information is unevenly distributed. By the time something becomes common knowledge, the easy decisions are already gone. That doesn't mean chasing price. It means understanding why price moved and what conditions would need to change for it to reverse. In this case, those conditions involve new refining capacity, new contracts, and new supply chains. None of that happens quickly. For businesses, the lesson is resilience. Supply chains built solely for efficiency break first. Redundancy looks expensive until it becomes priceless. For individuals watching this unfold, the most valuable skill is not prediction, it's preparation. Understanding how structural shifts work allows you to respond instead of react. This moment will be studied later as an inflection point, not because silver is rare, but because access became restricted. When access changes, value changes with it. That dynamic applies far beyond metals. If this analysis helped you think more clearly about what's happening beneath the headlines, subscribe, like, and share this with others who care about markets and real-world risk. And leave a comment with one if you want continued updates as this situation develops, or two if you want to pause here. The story isn't over. It's just no longer theoretical.